We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. There is no value added.
Hi, I'm Calvin, and welcome to Invest Smarter. In today's video, we're going to talk about what Warren Buffett meant when he said diversification is protection against ignorance. There's no value added. Let's get into the video. So what was Warren Buffett getting at when he said diversification is protection against ignorance? It has no value added. Well, I think in Warren's case, he's talking purely about equities. His idea is to go after a very small handful of companies that he has full belief in, and he's going to put all of his assets into that very small portfolio. For most investors, that's not practical. You don't have the time to analyze those companies and choose just a few. So for an average investor, that's a little bit risky. But even on a broader scale, what Warren Buffett said works out, right? So let's take a look at how that works out and why what he said makes sense. So if you're not used to my charts here, if you haven't seen my previous videos, this is actually fairly simple to understand, and I'll explain it in a very short amount of time here. So if you look at this chart, basically anything that appears up here, and right now there's nothing there, but anything that appears up here in the upper left corner, toward the upper left corner, is good. So you're getting higher return, less risk up here. Anything that appears in the lower left is bad, right? And the colors kind of illustrate that. And as far as these two axes on this graph, the vertical axis is the compound annual growth rate, or put it another way, it's like the average annual return that you would have gotten over the 15-year period before March 13th of 2020. The horizontal, or x-axis, is the amount of maximum loss that you would have incurred, most likely back in 2007 to 2009. So if you think about it, your portfolio went up, it peaked out somewhere in October of 2007, and then it dropped, well, in the case of the S&P 500, 55% by 2009, and you'll see that when I start putting some investments on here. And the reason this doesn't go to zero right here is I've expanded the scale out so you can see more easily how, for example, the S&P 500 compares to other less diverse investments. So let's stop talking about it and put the S&P 500 on the graph, and you can see that here, the S&P 500 had a compound annual growth rate, or kind of an average annual return, of 7.65% over that 15-year period, while back in 2007 to 2009, it had a minus 55%, had a very large maximum loss, which was pretty painful. So the S&P 500 is considered by just about everyone to be the true definition of a diversified equity portfolio. There is a little bit of everything in there. I mean, there's 500 stocks. It's quite a lot of stuff. So what happens if we take a 100 stock portfolio? In fact, it's less diversified because we're not looking to diversify it, but we're looking to find more forward-looking companies. So what I've just described to you is the NASDAQ 100. And if we put that in here, you can see, first of all, wow, instead of a 7.65% return, now we're looking at a 12.5% return, average annual return over the 15-year period. And our maximum loss was a little better, right? Instead of minus 55.19%, we're at minus 53.4%. Not a lot of improvement, but a little bit. So this by itself, I think, makes my point. Highly diversified, less diversified. Less return, more risk, higher return, slightly less risk. Now, I know that I can show you other examples of this, but rather than spend a lot of time here, let's get into portfolio construction and why diversification, the way it's practiced by most retail investors and most financial advisors, just plain doesn't work. This is where it gets interesting. We're now going to look at how typical investors diversify their portfolios to try and get better performance and better risk management. And we're going to show you really quickly why this doesn't work. So what are we looking at here? Well, if you remember the last graph, I had stretched out the maximum loss line so that there was, there was a little, it went from like minus 30 to, I forget, minus 70%. But here it goes from a 0 to 100%. And I've changed the return line a little bit to go from a negative return, minus 5%, up to 15% here. So what are we looking at? Well, now you're going to see a few different things here. So basically the size of the bubble represents how much of that particular investment is in the portfolio. So you can see these smaller bubbles, there's a little bit less. A large cap, there's about 10%. Small cap, there's 4%. Mid cap, 4%, and so on. There's a lot of aggregate bond index in here, 56%, and a little bit of high yield bond in here. So what you're looking at is the definition of a diversified portfolio. And this isn't my definition. This is a pretty standard definition used across the industry. You can look on websites and Google what constitutes a diversified portfolio. And there are many individuals and organizations that use this type of spreading your assets all over the place to try and get better return and less risk. So what we're looking at here is what they consider a conservative portfolio. Now, in my book, almost 27% maximum loss is not a conservative portfolio by any means. The return's okay, 5.16%, but the maximum loss is huge. And you can see what's in the portfolio. There's a lot, there's 56% of this aggregate bond index, which is a highly diversified bond index, and you can buy that with the ETF AGG. They have some high yield bonds in here. And as I've mentioned in previous videos, reaching for return on the safety side is not a good idea. It doesn't work. So that's another folly here. And then on the risk side of things over here, they've got some large cap, some small cap, mid cap, foreign large cap, emerging markets, real estate, and commodities. Basically everything but the kitchen sink. And now I'm going to show you why this doesn't work. And I think it's going to become really obvious really fast. So here's a conservative portfolio. Let's take a little more risk. Let's make it moderate. So let's move to a moderate portfolio. Well, what happened here? Well, let's go back to conservative. And you can remember the return's 5.16%. The maximum loss is almost 27%. And now what happens when we go to a moderate portfolio? Well, the return went up a little bit, not much, but the maximum loss went up a lot. It went up at least 10%. I mean, so you get this little tiny increase in the return and a big increase in maximum loss. That doesn't make any sense. Well, maybe this will work better if we take even more risk. Let's try that. Let's go to an aggressive portfolio and see what happens. Oh my God. So now the return went from 5.41% to 5.44%. Now that's something to celebrate. But the maximum loss went from, in the conservative side, minus 27%, to now the aggressive side, it's minus 48%. Yeah, it's a little better than the S&P 500 did at minus 55%, but not much. And you're getting less return than the S&P 500 gave you. So what's the value of this? None. All right. So now let's look at how you can construct a portfolio that is truly diversified and gives you some benefit for taking more risk. Now I'm going to show you a portfolio that you can do yourself that only needs somewhere between 2 and 4 ETFs to put together. You'll see what real diversification looks like and the benefits it can bring to you. So let's get into this. You're looking at the same graph, basically. I've changed the axes a little bit. So now the return, annual rate of return goes from 0 to 15%, and the maximum loss goes from 0 to minus 100%. So in the highly diversified case, you saw that you got no additional return for taking additional risk. In fact, you got a lot more loss for taking additional risk. And I don't know about you, but that makes no sense to me. If you're going to take more risk, you want more return. It's kind of logical. So let's create a simple portfolio here. And what we're going to do, let's start out with a conservative portfolio, one that I would consider conservative. And what we're going to do is we're going to put 20% of our portfolio in the S&P 500. And now we're going to take the other 80% and we're going to put 40% of it in short-term government treasuries, SHY. Those treasuries have a 1 to 3 year duration. And then we'll put the other 40% in IEF, which will give you, those are a little bit more risky. So the longer the duration, the more risk in the treasuries. What we have here is a portfolio that returned almost as much as that conservative portfolio we showed earlier. But look at the difference. The maximum loss was only roughly around 8% if we round it up. So we're getting almost a 5% return with about an 8% maximum loss, whereas in the previous conservative portfolio I showed you, we had like a 5.16% return with almost a 27% loss. This is a much better characteristic, and I would consider this a conservative portfolio. So now let's make this into a moderate portfolio. So what we're going to do here is now we're going to put 40% of our assets in the S&P 500, and we will put 60% in the 7 to 10 year government treasuries. Wow, well, look at this. Now, this is a moderate portfolio, and it has better returns than that over-diversified conservative portfolio and a better loss characteristic. So this is a much better way to go. And by the way, remember we talked about being less diversified on the risk side. Instead of using the S&P 500, what if we put the NASDAQ 100 in? Wow, now we're getting quite a bit more return. And the same would work for the conservative portfolio. So we can boost our gains here by being a little less diversified here. Now you might say, well, yeah, but sometimes the tech stocks get a little volatile for me, right? So, all right, well, let's put 20% here, and then put 20% in the Dow Jones Industrial Average. You know, that if that makes you feel better, you're still performing better here than you would have even with the conservative portfolio, and certainly better than the moderate or even the aggressive portfolio in the over-diversified case. So now let's take it up another notch. Let's change it from a moderate portfolio to an aggressive portfolio. And by the way, for me, an aggressive portfolio has no more than 60% exposure to risk assets. And you'll see why in a minute. So now let's use the S&P 500 again. We'll put 60% here, and in this time, instead of using 1 to 3 year treasuries or 7 to 10 year treasuries, we're going to go with 20 year treasuries. Now, why is that? Well, think about it logically. When you're taking less risk on the risk side, on the equity side, you also want to match that. It's kind of like, think of it like a teeter-totter. You also want to take less risk on the safety side. As you take more risk on the equity side, you need to balance that out by taking more risk on the safety side. And you'll see what happens here when I do that. So when I put 40% in 20-year treasuries, what happens? Oh, well, now my portfolio is performing substantially better than the S&P did, right? 7.65% here. I'm getting 8.5% return here, but I'm getting just a little bit more than half the loss. This is a really good trade-off. And if you'll notice, this portfolio doesn't fall between these two. It's actually performing better than either one of them. That's the beauty of using treasuries for safety and then risk assets like equities for the risk side. Now, I said I wouldn't want to take more risk than this. Why is that? Well, what if we go to, the typical thing that people recommend, financial advisors like to recommend for somebody who's in their 20s or 30s is, oh, you should be heavily weighted toward equities. So we're going to put you 80% in equities. Well, what if we do that? So let's make this 80%, and let's make this 20%. And by the way, if they were doing it, they wouldn't have the 20% in treasuries. Well, my return actually went down, right? It was 8.51%, if I remember correctly, when we only had 60% exposure to risk. Now it's gone down, but my maximum loss has gone up a lot. This isn't a good trade-off. And by the way, if you ever see your portfolio drop by 40%, my fear for you is that you'll become afraid. You'll sell it down there, which is what a lot of investors do. They take too much risk. A big loss comes, they sell it off, and then they don't get back in until the market's recovered. So what do? They lock in their losses, and it takes them years and sometimes even a decade to get back to where they were. So take less risk, get better returns, and live a better life. If you're still watching, thank you. I really appreciate you hanging around and watching this whole video. If you like this video, please hit the like button and subscribe, and I'll see you on the next one. That's all for now.